Hello, everyone. In this session, you're going to see the third part of the management accounting costing, and we're going to start from question number 8. So let's have a look. This question is very common in the exam to identify the cost structure. So it's like kind of the cost they'll give it to you, and you have to find it out what type of cost is involved here. So is it a variable cost? Is it a fixed cost, step cost, or semi-variable cost? So based on the question, you have to identify what type of question is involved here. So let's have a look at that. All right, the first one you can see here, it says the clause classification. And we have the question here. It says a P Limited is a reviewing cost for the next quarter for a UK contract R2U42. The cost analysis table below shows cost behavior per mile travel for 4 different cost classification. So we have 4 different mileage here. So 2000 mile, 3000 mile, 5000 and 8000. We have some cost classification. So it's set cost 1, classification 1. So if we drive 2000 mile, the cost will be 30 per mile. If we drive 3000 mile, cost will be 20 per mile, 5012 per mile, and 8007.5 per mile. So what type of cost it is? To identify that, we have to check few classification. First, we check with the 2000 mile. So if we check with the 2000 mile, 2000 times 30, it looks like it gives me 60,000. So I want to check, is it change or it remains same? So I'm going to check the next one with the 3000 mile. So I said 3000 mile times 20, again 60, and 5000 times 12, again 60. So it's look like 8000 times 7.5, again is 60. So it's look like whatever is the mileage, doesn't matter, the cost remains same. And this could be only possible if it is a fixed cost. So we need to say, regardless of the activity level, the total cost remains same. And this is the definition of the fixed cost. So you have to say this is a fixed cost. So you're going to choose that. That is a fixed cost. And 60,000. So even though if I drive for 6,000 miles, they said calculate and insert the total cost for 6,000 miles. So it doesn't matter it is 6,000 miles or it is 5,000, it is 8,000, the cost is 60,000 fixed. The next one we have here, number 2. Number 2, you can see in 2000 miles, the cost per mile is 9. In 3000 miles, the cost per mile is 9, and 5009 and 8009. So that means per mile, the cost is same. So regardless how many miles I drive, cost per mile is fixed. So this is the definition of the variable cost. That means if I drive more, I have to pay more. If I drive less, I have to pay less. So all you have to do, you have to multiply 9 multiply 6,000. And that will give us how much is the variable cost. So we can pick any of this because we can see any of the mile 2000, 3000, 5000 or 8000. Regardless, the cost per mile is fixed. So for the 6,000, it will be 6,000 times 9, it will give you 54,000. The next one we have a classification number 3. Says for the 2000 mile is 12, 3000 mile is 8, 5000 mile is 6, and 8000 mile is 3.75. Let's try to find some total. So 2000 times 12 and is 24,000. Then the next one is 3000 times 8. And again, it is 24,000. Then we have 5,000 times 6. That is 30,000. And 8,000 times 3.75. So let's check this one. 8,000 times 3.75, and again it is 30,000. So that means we can understand up to a certain level the cost remain fixed, and after that it jumped to the another level. So up to a certain activity level the cost is fixed, and after that it is jumped to for the another fixed level. And this is the definition of the step cost. So step cost, if you remember, it goes like that. Up to a certain period is fixed, then it jump again and fix again, then go again. So that's how it will go up. It's like a step. This is our step cost, and we have to find how much will be the step cost here. So they said between 2 to 3,000, the total step cost is 24,000, and between 5 to 8,000, the step cost is 30,000. That means between 5 and 8, the step cost is 30, and 6,000 mile fall between 5 and 6. So it will be 30,000. So say it will be 30,000, and it is a step cost. Step cost is fixed up to a certain level, and after that it jump to the another cost. And finally, the last one we have here. The last one we can see they are saying in 2,000 mile, the cost per mile is 16, 3,000 mile 14, 5,000 mile 12.40, and 8,000 mile 11.50. So let's try to do some working. So if it is 2,000 mile times by 16, so it is 32,000. Next one, it is 3,000 mile. Cost per mile is 14. So 3,000 times 14. So this 42,000. Then 5,000 mile times 12.40. 5,000 times 12.40. That is 62,000. And 8,000 mile 11.50. That is 92,000. So you can see when the mileage is increasing, the total cost is increasing. So from 2 to 3,000, the cost increased by 10,000. Then from 3 to 5,000, cost increased by 20,000. And from 5 to 8,000, cost increased by 30,000. So it's look like for 1,000 mile, the cost is increased by 10,000. For each 1,000 mile, the cost is increased by 10,000. So it's a look like it is a semi-variable cost, because some cost is fixed and some cost is variable. And that's the reason when the total mileage is increasing, the total cost is increasing. So when there is a semi-variable cost, because all the cost is increasing in the same manner, so it is a semi-variable cost. So you have to identify how much will be the fixed cost and how much is the variable cost to find it out how much is the total cost for 6,000 miles. So we remember that if there's a semi-variable cost, we have to use the high-low method to find it out, the variable cost per unit, so that we can identify the total cost. So let's do the high-low method. High-low method. In the high-low method, we'll take the higher unit, that is 8,000, and the higher cost. So 8,000 times 11.50, that will give you 92,000. I'll take the lower unit, 2,000. And the lower cost, 2,000 times 16, 32,000. So now we find the difference. The difference is 60,000. Here, the difference is 6,000. We'll take the unit under the cost. We'll divide. That will give me 10. This is variable cost per unit. So the variable cost per unit is 10. Now we're going to find how much is the fixed cost. You can pick any of this. So let's take the 2001. So total cost for the 2000 was 32,000. So I want to see how much is the variable cost here and how much is the fixed cost. Now we know variable cost per unit is 10. So all you have to do, you have to multiply 2000 times 10, and that will give me the total variable cost in 2000 mile. So that will give me 2000 times 10, it is 20,000. And the difference 12,000 is the fixed cost. So I have to do some workings. If you don't remember your high-low method, make sure you practice that. Now we're going to find it out how much is the cost for the 6,000. So we'll do very simple, 6,000 times 10, that is 60,000. That is my total variable cost, and the fixed cost you already have 12,000. Fixed cost is fixed anyway. Fixed cost is 12,000, and that will give me total 72,000. And we'll say it is 72,000 here. And this is our semi-variable cost. Semi-variable cost is the cost where we have a portion of fixed cost and we have a portion of variable cost. All right, that's it. So let's move to the next one. The next one, we have question number 9. This question is quite simple. It's a variance analysis question. All you have to do, you have to find the difference between the flexed and the actual. Let's read this question. PHL reviewing an actual performance against the budgeted for December for the International Services Profit Center. PHL budgeted to operate 8,000 miles. However, actual mile travel were 4,000 less than the budgeted. So basically, the question says the plan was for 8,000 mile, sorry, 80,000 mile, but actually it is 4,000 less. That means it is 76,000, isn't it? All operating costs are variable except the fixed cost. So all the operating costs are variable, just only the fixed cost is fixed. Complete the table below to show the variance analysis. Adverse variance must be donated with the minus sign. So if there is any adverse variance, you have to show in a minus. Enter 0 if any figure is 0. Okay, that's fine. Let's try to do that. So we have the budgeted figure. Following the budgeted figure, we have to make the flex budget. So my number of travel, the plan was 80 and the revenue was 120. So you have to find how much is the sales revenue per mile. What was the plan? So I said 120, 100,000 divide 80,000. That will tell me how much my plan was, the revenue per mile. So 1200 000 divide 80,000. 15, and you have to multiply this 15 with 76,000. That is the actual, and that will tell me my revenue should be that. My revenue should be 114 000. So I said my revenue should be 114 000. So what we understand from here, based on my plan for 76,000 mileage, my sales revenue should be 1140, but actual revenue is 1115. So you can see actual revenue is less. So according to my plan, my revenue should be 1140 and it's 1115. So 25,000 is less than the expectation. So if my sales is less than the expectation, this is not good for me. And if it is not good for me, it is the adverse variance. So 25,000 less, this is a adverse variance. Then we have the next one, driver wages and related cost. Driver wages and related cost. So we have total 250. So we'll do 250, 100,000 divide by 80,000 and times by 76,000. We'll do same way for all. So 250,000 divided by 80,000 times by 76,000. And this gives me 2375 237500. And the difference here is we have my actual is 236. So my direct driver wages cost supposed to be 237, but actual 236. So it is less. So if the cost is less, it is good for me. So I said it is a favorable. The difference is 1400. It is good for me. If the cost is less, it is good for me. If the revenue or profit is less, it is bad for me. Good is favorable and bad is that first. Vehicle maintenance, same thing, 180,000 divided by 80 times by 76. And that will give you 171 000. Then you find the difference between the flex and the actual. So my planned cost was 171, but actual 169. This is less. It is good for me. So 1800 is favorable. The fixed is fixed. So you don't have to do the proportion because fixed is fixed anyway. So you're going to take the same thing, 210, and find the difference. And it will give me more cost than my plan. 150 is that first. So my plan was 210, but actual 210, 150. Then I make the total, that is 521500. And the difference here is total at first 21950. So all I have to do, you have to do minus 25,000 plus 1400 plus 1800 and minus 150. That will give you the total at first, that is 21,950. This question is not difficult at all. So, but sometimes this question come in the exam. Identify below the variance that was the main reason. The main reason was the sales revenue. If you remember, the sales revenue was the biggest amount, that was minus 25,000. So you're going to pick that one. Sales revenue variance, it was the biggest effect on the organization for the profit. All right, let's move to the next one. Task number 10. This question from the NPV or from the payback period. So it is the investment appraisal question that will be always in the exam. So make sure you revise this question very well. So let's have a look at this one. It says P Limited considering two possible investment. Okay. The first investment is more risky than the second one. And the most important criteria here is for the project that will limit PHL risks. So basically they said we have a two project. The first investment is more risky, and here they're giving the priority for the risk limit. That means they want the investment back as soon as possible or as quick as possible. So they are not worried about how much they will get, but they are worried about how quickly they will get. So you understand the first one is talking about the payback period, because payback always talk about how quickly we'll get our investment back. The next one, they said for the second investment, PHL is more interested in the return offered by the project chosen. So next one, they don't worry about how long it takes, but they're worried about like how much will be the amount. So if the return is more, they go for that. PHL is looking at two alternatives for each investment. Project 1 and Project 2 are alternative for the first investment. So we have Project 1 and Project 2. So these two are alternative. So from here, I have to pick one. This is investment proposal 1. And Project 3 and 4, this is investment proposal 2. If you remember the first one, the first investment about the quick one. So how quickly I get the money. So you look at the payback period here. So first project, we can see out of project 1 and 2, look at the payback because looking at how quickly we'll get back. So 2.5 is the quicker one. So project 1, the money will come back within 2.5 years. And the project 2, money will come back 3.5 years. So we'll go for the project 1 because money will come quicker. The next one, net present value, this one, they said project 3 and 4 alternative for the second investment. So this is for the second investment, project 3 and 4. And here we're looking for which one give me higher return? So we look for the net present value between 31 and 46. 46 is the higher. They said go for project 4. So let's do this one. They said for the first investment, PHL should invest in project 1 because project 1 will give you quicker 2.5 years money will come back, as this is the quickest payback period and meet the company criteria. For the second investment, PHL should invest in project 4 because it gives the highest NPV. So project 1, quickly I'm getting back the money, that's why project 1. And the investment 2, project 4, because this will give us the higher return. All right, let's move to the next one. We have some question, I think from the ethics maybe. Review the 4 statements in the box below and identify whether they are true or false. Okay. The internal rate of return is always the same as a company cost of capital. No, it's not true. Internal rate of return is how much return we'll get from the investment. And the company cost of capital is the setup amount of money. So how much is the cost of your capital? For example, if you take 10,000 pound from the bank, how much you have to pay the interest? Let's say if you take 10,000 pound from the bank, you have to pay 10% interest. So the cost of capital is 10%. So when you invested this 10,000 to somewhere else, you have to make sure you get more than that because the money have a cost. This investment have a cost. So it's not true like it has to be same. It depends where you're investing and how much you're returning it. The next one, we have the net present value method, discount future cash flow back to present value. That's true. So net present value means all the future return it brings into the today's value. So all the money you're going to get in future, it brings this to today's value. If the internal rate of return is greater than the cost of capital for a project, then it should be undertaken. That's true, because if my return is more than the cost, then I'll take it. So for example, if my internal rate of return 15% and if the cost of the capital is 10%, I'll take it because I'll have a profit of 5%. The payback method use profit from a project to determine the payback period. Now, this for payback period is only concerned how quickly the money will come back. So it doesn't worry about the profit at all. So payback period only concern if I invest 100,000 pound, how quickly it will come back to me. All right, so this is the end of the question. I think like I have practiced the whole question, and obviously like this sort of question you will see in the exam. Make sure to practice the management accounting costing as much as possible. This exam is a little bit tricky in level 3, and I hope if your practice is not that difficult, the question is not difficult as long as you understand it, as long as you understand the concept and the logic. So hopefully this video will help you to study, and feel free to email me if you have any more questions.